Hey everyone, welcome back to Corporate Decoder, that place where we decode the confusing language of big business and uncover what is really going on behind the glossy reports. Today we're diving into Blue Owl Real Estate Net Lease Trust, or BORENT, as they like to call themselves. Get ready because this filing has some interesting moves, including a massive cash inflow and some important distribution news that will affect investors. So, what is the big news here? It looks like BORENT recently sold a whopping 23 million plus shares of its common stock. This wasn't just a small offering, they pulled in over $248 million in cash from this. This is a huge amount of money, and it is interesting to see how they're re-breaking it down by share class. Let's look at the breakdown. They sold Class S shares for roughly $125 million, Class N shares for about $25 million, Class D shares for $10 million, and the largest chunk Class I shares brought in nearly $88 million. This indicates they are actively raising capital, likely to fuel further growth or acquisitions in their real estate portfolio. It is important to note that the deals were exempt from the usual registration requirements, meaning they targeted specific investors under certain regulations, often institutional or accredited buyers, which is pretty standard for these types of large private placements. Now, a little detail for the keen-eyed investors. For the Class S and Class N shares, a portion of those gross proceeds went towards sales commissions and fees. For Class S, that was about $680,000, and for Class N, it was a bit over $368,000. While it is a relatively small percentage of the total funds raised, it is always good to see how much goes to intermediaries versus directly into the company's coffers. But that is not all. Amidst this fundraising activity, they also announced distributions. This is how companies share profits with their shareholders. On the 22nd of September, they declared these distributions for all the different classes of common shares. For the Class S shares, the gross distribution, meaning the total amount declared before any fees, was about 5.8 cents per share. After a shareholder servicing fee of less than a cent, the net distribution, what actually lands in the investor's pocket or their reinvestment account, came out to just over 5 cents per share. The Class N shares saw the same gross distribution of 5.8 cents. Their servicing fee was a bit lower, around 0.4 cents, leading to a net distribution of about 5.4 cents per share. Class D shares also got the 5.8 cent gross distribution. With a smaller servicing fee of just 0.2 of a cent, they received a net distribution of nearly 5.7 cents per share. And for the Class I shares, the lucky ones with no shareholder servicing fee, the gross distribution was 5.8 cents, and that is exactly what they received as their net distribution. It is interesting to see how these fees can slightly alter the net payout depending on the share class. These distributions are slated to be paid out around the 17th of October, either in cash or reinvested back into more shares for those in their distribution reinvestment plan. And for the formal sign-off, we see the Chief Financial Officer, Kevin Halloran, putting his name on this report on the 3rd of October. Now, let's zoom out and look at what this all means. BORENT is clearly in a growth phase, actively raising significant capital through share offerings. This aggressive fundraising suggests they have ambitious plans for their real estate net lease portfolio, likely intending to acquire more properties or expand their existing ones. The fact that they can command nearly $248 million indicates strong investor confidence in their business model and their management's ability to generate returns. The distribution announcements are also crucial. While the gross distribution is consistent across classes, the net amount varies due to differing servicing fees. This highlights the importance for investors to understand the fee structure of the specific share class they own. The decision to pay out these distributions, even while raising new capital, shows a commitment to returning value to existing shareholders. One potential risk to watch is the company's reliance on these large capital raises. While successful so far, the real estate market can be cyclical, and sustained access to such large sums of capital is never guaranteed. The company's strategy relies on acquiring income, generating properties and passing those revenues on to investors, so consistent deal flow and stable rental income are paramount. Overall, Blue Owl Real Estate Net Lease Trust appears to be executing a clear strategy of expansion funded by significant capital infusions. The strong investor interest and the consistent distributions are positive signs. However, like any investment in real estate, it carries inherent risks tied to market conditions and the company's ability to keep sourcing and managing profitable properties. What is your take on BORENT? As latest moves, do you see this as a smart growth strategy or a sign of future challenges? Let us know your thoughts in the comments below. If you found this breakdown useful, please hit that like button and subscribe to Corporate Decoder for more insights like this. And don't forget to join our Discord community, linked in the description for even more discussions and analysis. Thanks for watching, and I'll see you on the next Decode.